Then, in 2010, silver was in the 20s, and prices were already going up. It was September 2010. Also, that spread went through a ceiling that anyone who draws charts could see if they did it the way we do. And bam, it doubled in 7 months. It did happen again, but this time it was even more clear on the spread chart. Even a bigger base that goes back 10 years of ceiling silver to gold, couldn't get above that level of 1%, but at the end of November, it broke out above it. Bam. Silver goes crazy all of a sudden. In those rare times when a market has been stuck in a range for several years or decades, especially silver, we've done a lot of research in MSA momentum structural analysis using our own unique methodology, but again, we've been around since 1992. What's happening in silver right now is not normal, and don't expect it to always be this way. There are rules that most technical analysts use to look at a market: overbought, oversold, swing goals, and so on. These rules are based on the last couple of years of that market. They are still living in that world with silver. I believe they are going wrong, using silver as money. Don't forget that it's money. Silver is like surfing on 2 waves, not just one. The most important one is how silver and gold are used as money. That's the main thing that makes those metals' asset values different. But silver is also used in a lot of different industries. These industries are growing quickly because of the need for silver in high-tech areas like data centers, computers, solar panels, and so on. It's demand that is higher than supply, and it has been for 5 years. It keeps going up, which means the gap grows. Because of that, it has a real problem. That's the other wave that most people are paying attention to. The desire for silver because of this, that, and the other thing. They forget that it's money and that it has historically been worth much less than its mother metal, gold. And this is one of the rounds that set off the last 8 weeks of silver's action. I'll tell you what it is. With gold, silver goes up and down. It has worth that goes up and down, and you can draw a chart of it. And our way is a little different. It's not something we do. That's what we do. It takes 1 ounce of silver to split 1 ounce of gold, which gives us 80%. Silver is one of a kind because it rides 2 strong demand sources at the same time. First, it is a valuable metal that has been linked to gold in the past and is believed to keep value when the economy is stressed. Second, modern business can't work without it. Silver is the best conductor of electricity, and it is used in solar panels, data centers, power grids, and AI systems. Global demand has been higher than mine production for more than 5 years in a row. People haven't yet priced in that debt. A lot of people only think about silver's use in industry and forget about its role in money. That mistake is very important because when monetary demand starts to rise again, price changes happen quickly instead of slowly. And if you look back more than 50 years, say to 1975, and plot what the best reading was for silver compared to gold at the end of the month that year, what was the best reading? We Planet 2. Okay, indeed, during the silver bull market from 1979 to 1980, the price was still within that range, which was between $4 and $50. During that rise in 1979 and 1980, silver prices went up 4.5 times in 5 months, hitting $50 for the first time in 1980. This was part of an ongoing bull market for both silver and gold. Okay, what made the silver bull trend that was already going strong jump up and do it all at once? What was expected completely changed the way things were in real life. Okay, silver and gold had been going up again for years by 2010 and 2011. It was a layered type of progress, which was frustrating for the bulls but still up. Then all of a sudden, from September 2010 to April 2011, or 6 or 7 months, the price of silver doubled. In September 2010, it was in the 20s, and all of a sudden, it went back up to 50. It did that for years ahead of time. In the last few quarters, all of a sudden, it went crazy again and stopped at the top of the old range, which is now 50 years. Was a range of 50 years. What made that bomb go off? Shouldn't it have gone up to those high points the same way it had been going up? What made it go crazy? If you look at the difference between silver and gold at that time, you'll see what looks like a ceiling. I'm now talking about details. Every month on that spread chart, you draw the difference B. During that bull market for silver and gold, silver just couldn't get above a certain level in relation to gold. Suddenly, it popped above that level, which would have been in the summer of 2000 or 1979. When it did, the price of silver went crazy, quadrupling in half in 5 months. Instead of just looking at price, silver's relationship to gold gives you a deeper signal. Roofs and floors are made by this interaction over many years. When silver fails over and over to beat gold, pressure builds up without being seen. In the past, when the price of silver goes above long-standing relative ceilings, things change in a big way. This took place in 1979 and again in 2010. Both times, silver prices were already going up. But once the link between gold and silver was broken, prices shot up very quickly. Today, the same relative rise happened again after a much longer base. This suggests that the next move could be bigger, faster, and more upsetting. Then in 2010, the price started going up in September. Silver was worth $20. If you plot the spread chart the way we do, anyone making a chart could see that the spread broke out over a ceiling. And bam, it doubled in 7 months. Okay, everything was the same this time, but the spread chart made it even more clear. Even a bigger base that goes from silver to gold over 10 years. From silver to gold, it was impossible to get above that number or that percent. And the end of November broke out above it. All of a sudden, silver goes crazy. In many other markets, that amount of time is seen when the market has been stuck in a band for years or even decades. Copper did something like this. From the 1970s to 2005, it was between 50 cents and $1.50. It broke out above that level in the last quarter of 2005 and went to $4.50 in just a few quarters. Bam, $50 to $450 by itself. It wasn't linked to other based metals, for instance. It did it by itself. Had nothing to do with what gold and silver were doing. After 15 months, lead did the same thing. You could make a lead chart that went back many decades, and it was set in this old world. When it broke through that in a few quarters, the price dropped by 4 times. Everything was squished back into a couple of quarters on its own. Had nothing to do with the copper move at all. So, we've seen these kinds of things happen in other markets where prices have been the same for so long that you can't believe it. It's getting old to you. You believe that living forever is the truth. It doesn't. And when the market adjusts to a new reality, it does so quickly and in an exaggerated way. We see bubble tops in the stock market, for example, and a lot of people think, gee, I should have known that. And sure enough, the crash that followed was pretty dramatic. O.com hit its highest point at the 2002 low point. In 2 years, the NASDAQ 100 fell 82%, which burst the dot-com bubble. Okay, 2007 to 2009 process of the same kind. But the point is that when a market does something wrong, either too much on the upside or too much on the downside, as happened with silver, which got stuck in a 50-year range when every other market in the world, copper, lead, and gold, didn't. That one market got stuck in that range. Copper used to be worth 50 cents to $1.50, but now it's around $4.50. It's now about 5 o'clock, almost 6. Rise up. Silver isn't the only one who acts this way. When markets are stuck in long bands, they often look dull until they change. Copper prices were very stable for many years before they went through the roof in the mid-2000s. Lead then did the same thing with its vertical repricing. These weren't smooth changes. They were revaluations that were sped up. Silver has been stuck for longer than most, almost 50 years, even though gold, copper, and other assets have broken out into new price realities. When a market stays below its fair value for too long, it doesn't get caught off guard. It comes quickly, going over schedule to make up for lost time. When prices stay in that range for a long time, like silver did for 50 years, even though copper and lead both left their ranges in 2005 and 2007. And each time gold went up in price, it was much higher than the previous high. It was $850 in 1980, then 1920, and now it's $4,000, etc. So why did silver get inside? What's going on? It messed up. Now, it's possible that it was a forced mistake or even manipulation, and we know that some banks, possibly with the help of central banks, may have been playing a game to try to keep the cap low for some reason. In the end, that didn't work. Okay, but when silver goes off like it is now, I think you'll see a huge move that will blow your mind in the next couple of quarters since that spread breakout. It's not going to happen in steps. You're going to a different world. It doesn't surprise me that it's in the several $100 range. Along those lines, Eric Spratt said that if you reduce silver or make it fit the growth of money, it would probably be worth $200. I think I gave a talk after he did one in Toronto in October. It would be fair to just keep the old highs. Wouldn't you take into account the amount of money that is in circulation and how quickly it is lost? Okay, well, heck yeah. Let's say that's the new normal, the new truth. That would make sense. When markets go from too much of one thing to too much of another, they often go too much of the other thing on their way to the new reality. That looks like where silver is now. And so the people who are constantly saying, sell it, take profits, it's going to go back to 50. It's got to go back to this old high here or there or whatever. And then, a week or so ago, we dropped 15% in silver sober in like 2.5 days, and a couple days later, you're back to the high. What are they thinking? Don't they realize that this is not a normal advance? You don't get these multi-month corrections anymore. Now they're measured in days. And frankly, we expect to see silver reach, my minimum is like 200. But I wouldn't be shocked if it approached 500, tell you the truth. And there's certain other factors in play in that regard too. We could talk about if you want to. In a revaluation phase, pullbacks behave differently. What once months now takes days. Sharp declines are rapidly erased because underlying pressure hasn't been relieved. This is why traditional momentum indicators fail. They were designed for stable cycles, not structural breakouts. During prior silver explosions, technical measures stayed overbought for extended periods while price kept rising. Selling early based on those signals historically meant missing the core of the move. This phase is not about timing perfection, it's about recognizing context. Silver is transitioning to a higher equilibrium, and volatility is a feature, not a warning. We do know there has been deliberate attempt to keep it down, banks and so forth. And I think there's actually been some convictions, and marketplace convictions, Justice Department, so forth, of attempted several years ago of attempt to, manipulate the market. But we don't analyze silver from that point of view, the fundamentals. So we know we have a supply-demand deficit. We've had that for 5 years. Why is silver only now responding? Well, pent up pressures, the ongoing demand by China, essential for their solar panels. They're 80-90% of the global solar panel production, and silver is essential in that. And also, we hear all about these AI data center, power center, so forth. Well, silver's essential in that here, there, and everywhere in micro form and larger form. You can't get rid of it. It's essential because of its nature of the metal. And so those demand factors are continuing to grow, and it's not been priced into silver, the supply-demand issue. And so if it's made an error and not already responding to that by incremental growth to respond to that ongoing demand, which it's not done, then when it catches up, it just does it in a maniac way. And actually, it's rational because it gets from point A to point B, where it should have been anyway, perhaps 10, 20 years ago, and does it in a lightning form. And copper did it, lead did it, gold does it every bull market. In fact, a point about gold right now. The mama metal. It's not a primarily industrial, it's primary money, okay? You had of the last 50 years since the government legalized it, quote unquote. You had the bull market. It peaked in 2000 but dropped in 1975 when it was legalized. Soon as it was legalized, it peaked and dropped to 103 in mid-1976. That was a bare low 50% pullback. From that 76 low at 103, it went to 850 in 3.5 years. Okay, eightfold gain, bare low, bull high. Okay. Then for multiple decades, it went sideways, but where the $200, $300, $400 level. Okay, well off the 850 high, but still way above the old reality. It prevailed in the 1970s and so forth. In 2001, it made a low at around $260, and a decade later, it was 1920. Another eightfold move. Bear low, bull high under conditions that aren't anywhere approaching the fundamental realities that are now underlying gold. Okay, looking forward, the implications are staggering. If gold merely repeats its historical pattern, much higher prices remain plausible. Silver's valuation relative to gold has historically reached levels far above today's readings during bull markets. Even a partial return to those norms implies multiples, not percentages. Add persistent industrial shortages, rising monetary stress, and years of suppressed pricing, and the setup becomes extraordinary. Silver is not revisiting its old range. It's abandoning it. Those who wait for normal conditions may find that normal no longer exists. The next chapter for silver is not subtle, and it may not wait. Gold's bear low this time was in 2015 at 150. Eightfold says somewhere about 8,500. Okay, we're 4,500. We're only a fourfold move. We're only half the dimension of the prior two bull markets. What if gold does it again, which is hardly like a shocking thing to have another eightfold move? Okay, big deal. Wow. Where would silver be if, let's say, silver now rushes up to, let's say, 2%, even an ounce of gold? Oh, wow. What would that be? 8,000 gold, 2%. You get the point. What if gold doesn't stop at its old eightfold move again? Because something different's going on this time. And what if silver, instead of going to where it's been in the last 50 years, that relationship has at least been 2% in 20 of the last 50 years? Divide silver into gold, at least been 2%. We saw a low this year at about 1%. Dirt cheap, free silver compared to gold. Okay, if silver doesn't just go to the norm of 2%, which it's been 20 years of the last 50, and does what it did during the bull trends, if you go back and look at that spread relationship in 79 to 80, it was 612%. Or in 2010 to 111, it reached over 3%. That's a doubling from where it is right now. Okay, so instead of 2% of the price of $8,000 gold, let's say, assuming gold only does the norm, what about 3%? What about 6%? Which is what it did in the last two bull markets. We're in a bull market now. So wouldn't the spread go up and at least challenge the spread relationship it had in 1980, 2011? Heck, prices above those highs. Why shouldn't maybe the spread relationship also go up and challenge those highs? So the ceilings come off silver, both in its relationship to gold and its own technical situation. So it's a monster, and if you don't treat it that way, and if you treat it like, oh, RSI is overdone, you'll miss the move. In fact, the fact is that if you do monthly RSI, a popular so-called momentum metric, we ignore it. But it's popular. In the 79 to 80 move, RSI on a monthly basis got above 80%, which is the upper, overbought level for a year. So when it first got to 80%, if you said, oh, I'm out, it's overbought, you missed the whole move from, say, teens to $50. Okay, you missed the whole move. So throw your norms out the window. This is not a normal situation. That's our assessment. And yes, if we get what we expect in the next 6 months, we will be more careful about locking in, especially leveraged positions or call options. I don't think silver will ever collapse again. It may collapse from, say, $400 in 6 months and drop back to $250. That's what will happen. But it won't go back to this old reality. It's going to much higher levels. And if you're not there for the next 6 months, I think you'll miss it.